It's a great pleasure for me to be able to introduce and welcome a great friend of CEPR, a longtime ally, somebody who serves not only as advisor to CEPR and to myself, but also as our trusted partner here in Paris. The Banque de France, as you will know, is one of the most important partners for the CEPR. Here in Paris. Agnès is the deputy governor of the Banque de France with a huge portfolio of responsibilities. And she is also, as you know, an economist who has written about everything that is important or needs reform. Right now, what is important and needs reform, and we may have a second chance, is the Capital Markets Union, or the Savings and Investments Union, as it is sometimes called these days. And she has agreed to give a keynote on this. Thank you very much for being with us, Agnès. The floor is yours.
Thank you, Beatrice, and thank you very much for the invitation. It's a great honor, and thanks for all of you for being here Saturday afternoon, just before Christmas in Paris. So I'm very, very much honored. And so I wanted to perhaps walk you through the 10-year history of the Capital Market Union. I will, well, it's very standard outline of my talk, what does I say, and then where do we stand, and finally what to do. So what's at stake? So I just said the Capital Market Union project was launched in 2014, just so a few years after the global financial crisis and the euro area sovereign debt crisis. The emphasis at that time, you need to step back, and at that time, the main problem was instability and how we could get more macro stabilization. And the idea was driven from this literature on risk sharing, starting with the paper by Azobali and others, showing that in the United States, actually, the capital market is doing more in terms of stabilization than the federal budget itself. And in the EU, at that time, the Capital Market Union was considered as complement to a banking union, which already should have, when completed, done some part of the risk sharing. Now, 10 years after come the Draghi report, the Letta report, so I should say the Letta report, and then the Draghi report, other reports. There's a statement by the Eurosystem in March 2024, and the emphasis there is on allocation. So the motivation is mainly to finance innovation and the transition. The narrative is that capital market in the US is deeper, more liquid, and better equipped to finance risky investments through equity. And in the EU, so the idea is to lower intermediation costs, and this will improve the risk-return trade-off for savers also. So in a sense, in my view, the move from Capital Market Union to the new branding, which is Saving and Investment Union. In fact, these are the two sides, to a certain extent, these are two sides of the same coin. The idea that better capital allocation can be driven from enhanced risk-sharing trade-off. So I take this first graph from the Draghi report. These figures are a bit striking and depressing for the EU. So these are the EU versus US gaps. The first bar, blue bar, is the household saving rate. So we all know that the savings rate in the EU is much higher than in the US, almost 10 percentage points in 2023. However, private and public investment, even public investment actually, but private productive investment, I'm not talking about buildings, productive investment is lower in the EU compared to the US. And at the end of the day, you have the yellow bar, which says that over the period between 2009 and 2023, the net household wealth of households increased less in the EU compared to the US by almost 5 percentage points per year. which means that, well, the savers in the EU, they save more, but they get less wealth. So it must be a story of return. And so the or save less. Yeah. So the diagnosis is quite shared today. Lack of equity in the EU caused by, first, the prominence of bank intermediation, which is a long history, the lack of pension funds, the lack of exit options for venture capitalists. Second, the market fragmentation, which is due to different legislations. A lot of emphasis has been put on differences in taxation and insolvency regimes. Second, the fragmentation of market infrastructure, central counterparties, CSDs, so depositories, and also fragmented supervision. Third, and related to the other points, the lack of portfolio diversification, limited size of the funds, not just the venture capital, but all kinds of funds, and limited securitization in the EU compared to the US. And finally, a fragmented and complex public-private co-financing, which could be a strength of the EU, and in fact, it's a weakness. So, just one other graph, which is how EU savers allocate their savings. If you add up the gray, which is equity, both listed and unlisted, and the, let's say red, which is, no, not the red, the yellow, which is investment funds, shares, or units, you see the difference, the striking difference between the EU 27 and the US, with the US almost at 50%, whereas for the EU it's just 31%. And secondly, there is not much progress since the previous period. Now, how would Savings and Investment Union provide more risk sharing and better risk return? So more risk sharing, we have recent papers, one by Martinez, Philippon, and Sinoven, on the distinction between money market union and capital market union. With the money market union will help smooth demand shocks efficiently, whereas you need capital market union, so cross-border equity holdings, in order to smooth supply shocks, because these shocks affect the value of private assets. So this is a theoretical paper. Then you have empirical evidence. Here I mentioned two, Hoffman and others, showing that risk sharing is enhanced by cross-border banking and equity holdings. And this is not to be confused with the interbank market. So they show that, of course, you have less than you used to have, but an interbank market, and the interbank market is not a substitute for cross-border loans and cross-border equity holdings. And another paper by Dufresneau, Gosset, and Claire, actually from the Banque de France, shows that higher integration of the bond and equity markets improve risk sharing in the long term. So, this is for risk sharing. And then better risk return. Let me show you the impact of capital market union could have on the benefits for savers. So this is a study by Gosset and Gell in 24. They estimate the potential diversification gains for enlisted equities in the EU over a period of 10 years by comparing the Sharpe ratios. So it's a kind of measure of return corrected for risk. So take the case of Poland, which is the first bar. So these are two different measures, but with similar results. So so with better diversification, so with the optimal diversification, the Polish saver could have reaped something like 0.7 percentage point higher return on his or her savings over this period, corrected for the risk. Okay, so where do we stand? So where do we stand in terms of the project itself? So it's not that over the 10 years, the Europeans have not been active. There have been. And here you have a list of projects. So there have been 2 action plans, more than 30 measures adopted. Here you have a number of them. The review of the Solvency II regulation for insurance companies with more favorable treatment of long-term equity. You have the regulation on venture capital funds that now may market themselves across the EU with a passport. So without all the authorizations on country-by-country basis. The ESAP, the digital single access point about EU companies and EU investment products that has been introduced. The EU directives, the very important EU directive on 2019 on corporate bankruptcy procedures to make them more efficient and harmonized. I will come back to that in a minute. And finally, for retail investments, the retail investment strategy to improve the information of the investors and to ensure that they are treated fairly and duly protected in a harmonized way. And the faster directive proposal today, which is about double taxation to simplify the treatment and of the refund procedures when you have withholding taxes, hence the risk of double taxation. Just let me zoom in on insolvency procedures, which are often mentioned as a major impediment to the Capital Market Union. The directive in June 29 on restructuring the insolvency was extremely important, with an emphasis on early restructuring, so before we go to courts, and also harmonized treatment of creditors with introduction of classes of affected creditors with an ordering of them and a so-called cross-clamp from down, which means that a plan may be adopted despite the negative vote of one or more classes if the majority of the classes votes in favor of its adoption, provided that at least one of them is a class of secured creditors. So it's a bit long, but it means that it clarifies the way the creditors are treated and it harmonizes also the way they are treated across the EU. So it's not perfect yet, and you see here, so this is taken from OECD study. So these are an index for insolvency regimes in the EU. So the higher, the less efficient. And the figure for 22 is in green here. And you see so those countries with the least efficient systems have traveled. In general, they have traveled more. And you see the first country here is Greece now today. So this is quite interesting. We are not yet there because you see the difference across the green triangles. So there is still some way to go. And there is a proposal which is still pending from the Commission in 22 to go further, especially in terms of preventive procedures. Maybe I will skip this. On another topic, sustainable finance has been also much action, mostly in the direction of more transparency with the introduction of the EU taxonomy to classify the assets. The CSRD directive, which imposes some disclosure for companies and funds and banks to ensure proper transparency for all stakeholders, and the MiFID II directive that makes it compulsory for intermediaries to collect their clients' sustainability preferences before offering a financial investment. So all these to fight greenwashing, and in order to make this segment of the capital market more fluid and, well, actually to make it grow. There is a new sustainable finance package in 23, augmenting the taxonomy, and also a very important point, regulating ESG rating providers, again, to reduce the risk of greenwashing and raising the confidence of the households and on these ratings. Still, despite all these efforts, if you look at the index of integration that is calculated by the ECB, especially if you take the orange line, which is based on quantity-based indicators, it's quite rather flat. Okay, 10 years of capital market efforts to do the capital market unions and almost and a flat indicator. So in practice, what does it mean in practice? Because sometimes it appears a bit abstract. Okay, so I take two examples. First, the case of a retail investors. I am a retail investor. I want to invest cross-border. What is the problem? So first problem, lack of standardized information. Despite the regulations I've mentioned, it's very difficult to get information. I want to invest in, say, Spain, and it's quite difficult for me to get information on the savings product there. Second, risk of double taxation. So that I mentioned the faster proposal to reduce the risk for double taxation, but this is but today it's a lengthy procedure to get refund. Third, heterogeneous insolvency laws. I've just mentioned them previously. So some progress have been made, but the challenges remain. And if I just take the faster directive proposal, it's going to be compulsory for large member states, but optional for smaller member states. Okay, so they have the choice not to transpose the faster directive, which, well, it's something that doesn't fully embrace the capital market union. Now, take the case of an investment fund. So I'm an investment fund, and I want to sell my products cross-border, across the EU. What is the problem? I'm facing 27 different jurisdictions. I need to face heterogeneous requirements and regulations to market my product. And in each country, I need to be authorized twice by the national competent authority, first to operate, and second to sell my product. So some progress has been made with the UCITS and AIFM directives that cover a large group of funds, investment funds. For these funds that are covered, there is an EU passport now, and so you can comply. If you comply with a common set of rules in one country, you can operate and sell your product in another member state. You just need to notify in that country, not ask for an authorization, but you just notify. Still, there are some challenges. The prospectus that needs to be written to sell a product may differ in the different countries. And also the prudential supervision is different because the authorities are different. So the consequence, so this is a study by the Commission on the home buyers. Initially, I could not believe it. So the home buyers, so here you have the home buyers, for instance, in 23 is 87 percentage points. It means that, so in 23, the share of domestic equity in a domestic portfolio on average in the EU is 95%. So 95% is domestic equity. And the share of domestic equity in world equity, the outstanding amount, is only 8%. So the difference is 87%. Huge home bias, which differs across countries, but so the minimum is Ireland. Italy actually is quite low compared to other countries. On the right-hand side, you have Eastern European countries. Surprisingly, I see Denmark there, and maybe Signe can explain to us. So, tentative roadmap. As I said previously, there have been several reports. Also, I mentioned Noyer, who was actually the first one, I think. And they converge on the headlines. Especially here, I'm mentioning 4 items: securitization, to restart securitization in the EU, venture capital, market infrastructure, and supervision. I will concentrate on market infrastructure and supervision for the sake of time. So the Banque de France is working very hard on the 4 items, but I will only focus on 2 of them. Starting with supervision. Frankly, if we are not able to unify supervision in the supervision, then it's difficult to argue that we are serious for savings and investment union. So this is absolutely key to work on this. There are inefficiencies and costs related to fragmented supervision, regulatory arbitrage across jurisdictions, distrust also, because yes, countries need to trust each other in order to authorize their savers to invest cross-border and vice versa. Huge compliance cost, which reduces the competitiveness of European firms and is an obstacle to scaling up, hence to finance, innovation, etc. So there are various ways of reshaping market supervision. We already know a number of schemes that do work, the SEC, the SSM, competition authorities in Europe, so there are different schemes. It doesn't mean that national authorities would disappear. I think that the EU has shown some capacity to invent truly federal models that do respect national authorities. It doesn't need to be overnight. It can be phased in, starting with larger institutions or markets. But definitely we need to address a vested interest, especially for some member states. And on this, maybe the CPR community could help, because if you reduce the barriers to cross-border trade, then you expect, yes, more flows. How much? What gain in terms of return? Do you trust? So I showed a graph, but there are other ones. And what is the impact on the market structure? So is it that the winner, some firms will reap all the gains? So would you expect concentration? To what extent could there be concentration? To what extent would it be more efficient to have larger institutions, fewer but larger cross-border institutions? So on this, we really need to put figures. Because it's not enough to be qualitative. So if you have good references, I'm very much interested. And if you can do further research, it would be fantastic. Here, I would like to address something that could appear a bit contradictory. Because the Europeans say, well, we want to do capital market union. But then you need institutions to do that. So these will be non-banks. And at the same time, they say, oh, the non-banks are very, very dangerous. We need to regulate them. Okay, so how can we make this consistent? And I think we really need larger non-banks, NBFI, non-bank financial institutions, but regulated non-banks. And there are already some regulated non-bank financial institutions, pension funds, insurance companies are highly regulated. And other parts of the system. So it's very diverse. So some parts are not much regulated at this time, and they could raise some systemic risk. So what is the impact on NBFI on the market structure? So there is some literature showing that NBFI is more prone to hold riskier assets in good times and could sell in bad times. So they are more cyclical. Hence, the importance of controlling the leverage and the liquidity and reduce procyclicality, say, of margin calls on derivative markets and repo markets. Because they are dependent on repo markets, that they don't have access to central bank liquidity, so it's even more important to regulate the liquidity. They can provide liquidity to the markets in good time, but not in bad time. So we need to also have this in mind and think about what we do in bad times. They can also they can also contribute to reducing asymmetries, informational asymmetries and transaction costs also in good times. So I think the growth of non-bank financial institutions must be viewed as an opportunity for capital market union, but they have systemic implications which need to be addressed. Now I move to the second item I wanted to discuss, and it will be the last. Improving market infrastructure through unified shared ledger. So Signe already talked about it in the previous in the previous session. So today we have a very efficient existing infrastructure, Target 2 and Target 2 securities, which is a common platform where securities and cash can be exchanged very fast and simultaneously transferred. So this is called delivery versus payment. The limitations of this infrastructure in the euro area is that the securities are stored in multiple depositories, central securities depositories, CSDs. There is no integration with central counterparties, and there are operational risks related to this, credit risk and cost. And on top of that, we have a challenge, which is to speed up the settlement, because today is T+2, and we need to go to T+1 like the US, maybe sometime T+0. So this cannot be done with this fragmented infrastructure. Now, what is the project of European shared ledger? So the idea is that we have a platform on the DLT where wholesale CBDC, tokenized deposits, and financial instruments could coexist as tokens under a single European governance framework. It could be phased in, building on existing infrastructure, step by step. And this is not, I want to say, this is not science fiction. There are already very successful experiments being implemented, even with real money. I know it because in my new job, I'm chairing the risk committee, and we have to approve putting real money in these experiments. So it does work today. So the idea is to make it automatic and streamlining the payments and the securities process, hence to reduce the settlement risks and operational costs. In a sense, it's a way to leapfrog the market fragmentation. So how to explain it in plain language? So today, you have two banks in the euro system, in the euro area. Bank B sells traditional securities, say a bond, to Bank A, and the settlement will go through Target, through the euro system, okay? And the traditional securities, I didn't draw it here, but it's on T2S, so there is a platform to exchange these securities. However, Bank A and B are starting exchanging also tokenized securities. So it's the image of the classic security, but on the tokenized, in the tokenized world. So the idea is that they could exchange, so Bank A could buy a tokenized bond from Bank B and settle in central bank wholesale currency. So in a sense, it's just replicating the existing system, but in the world of tokenized assets. So the advantages, I already mentioned some of the advantages in terms of streamlining, reducing the cost and the risks. There is also a challenge in terms of unicity of the currency, because if we don't do that, what will happen? Bank A will pay with another currency, which is outside the central bank. It's a tokenized private money, tokenized deposit. It could be a crypto. It could be anything else. And then this alternative payment could have a different price from the central bank currency. You no longer have you are no longer sure that €1 of red money would be equal to €1 of blue money. So there are multiple cases, but probably I don't have the. So for instance, ETF, which are indices of different baskets, So currently, the securities are stored in different CSDs, so it's extremely costly to handle, and intermediation costs are high, and this could solve some of these problems. So conclusion, I think that what has already been done is something. We should not, we should consider it as positive, but we need to accelerate. It doesn't need to be a big bang. And what I want to say also is that some people say, oh, it will never happen until we have full convergence of regulations and taxes. And I'm not sure. We should not take this as a justification for not doing anything. I think, so I try to convince you that new technology, in terms, especially for post-trade, can help leapfrog these obstacles of lack of convergence. For instance, for bankruptcy regulations, you could have, so the differences in regulations could be included in the smart contract on the DLT. So you automatically, the securities travel with information on the home regulation. So we need also to rely on existing institutions, so existing supervisors, but coordinate them more and giving more power to the center compared to the periphery, and complementing existing market infrastructure. The idea is not to substitute T2, target 2 securities. And here also I would ask the CPR community to help show evidence on the implications of such steps in terms of cost, in terms of lengthening the planning horizon of borrowers, in terms of helping them to diversify, and help smaller issuers, I didn't mention this, but smaller issuers like medium-sized enterprises to issue bonds, hence to have an alternative to bank loans, to issue equity, also to know their shareholders, because today they don't have a clear view of their shareholders. On the DLT, they would have real-time information on who are the shareholders. So all this kind of information would make the market much more efficient. It would also help to scale up the funding, and also some countries who specialize very much in NBFI could find an advantage because they have the incumbents that could reap benefits of growing thanks to this integration. And finally, don't forget, NBFI regulation is part of the roadmap. It's not contradictory, and we should work hand in hand with the regulators. Thank you very much.
Thank you very much, Agnès. You have told me before that that you would call for research in this area, and I hope the call has been heard. I also think that since not everybody is in this world, it is also very enlightening, simply, as always, to listen to you and to hear that a lot, in fact, has already been achieved that we may not be aware of. And that, again, merits research efforts. We've taken a few minutes from the next panel to have some questions. Let me see a show of hands. Oh, that's a problem. Okay, I will come from the back and I will ask you please to ask short questions. Weder, you start in the back, yes.
Thank you, Beatrice. Thank you, Agnès, also for your interesting talk. I agree with your implicit option that the equity market is more important in a CMU project, but it's not the only one. You left totally aside the bond market and the capital markets union in bond market, particularly linked, of course, necessarily, if it is to exist, with a risk-free European asset. There are many ideas around that do not imply even mutualization. And then my question is, why didn't you talk about it? Because it has at least two big functions. For risk sharing is important, the unified bond market, and is also important for valuation purposes in what regards the functioning of an European equity market. So I don't see very well how a full-fledged capital markets union can exist without an European bond market.
Thank you. Let's keep collecting. Over there is the next question.
I'm loud. I can start early. Can you comment on the possibility that after you build this beautiful market, the home bias numbers don't change?
Please use the microphone. We are online.
Can you comment on the possibility that after you build this beautiful single market, the home bias numbers don't change because they're driven by preferences of investors rather than barriers in the institutions?
Okay. And Richard here.
3 quick points. One, you said rightly that we need cross-border integration of banks rather than the interbank market as such. But we know there are huge political obstacles to that. We've seen that recently. How is it likely that those obstacles are going to be overcome? The second question is, I really didn't understand, and maybe I hope you can explain, the point that single supervision is not the same as centralized supervision. I think, or the disappearance of national competent authorities. The single supervisory mechanism overrides and makes inoperative the role of national competent authorities for a certain subset of banks. What's the difference here? And finally, there's a trade-off. I agree that we need to regulate liquidity and leverage of NBFIs, those that aren't regulated, but there's a trade-off here. There'll be a huge pushback on that. What's the trade-off? The trade-off may be to offer them access to the central bank balance sheet. And what would you think of that? That is to say, to let them access central bank liquidity when they need it.
Okay, thank you.
Thank you, Victor. I didn't want to set aside the bond market as it in general, but I had in mind more the corporate bond market than the sovereign bond market. When you talk about a safe asset, usually you think about sovereigns. And here I intentionally put aside the safe asset issue because some rushing to this issue of a safe asset, it will stop, in my view, it will stop the project, whereas there are other things to do, and people are extremely, this is really a very, very contentious issue. And so I don't think, so this is where we differ. I don't think we really need it to implement capital market union, although, as you know, I have contributed to papers advocating a safe asset. So it doesn't. It's not a contradiction in my sense, but we should not wait until we have a safe asset to make. Yeah. Okay. So could the home bias not change after we've done all these nice reforms? I guess Mario Draghi would say, well, it's a pity because today, in fact, the cross-border investment are done overseas in the US. So the internal market is not fully, the diversification within the EU market is not done. People would not do it individually. It's through the funds, hence the discussion about the NBFI. So if investing cross-border in the EU with less information asymmetries and in other countries and with scaling up of the investment standardization. I didn't talk about securitization, which will be also a way to do it. Well, not sure the bias would disappear, but if if you have similar opportunities within, especially the euro area, as with the US, but no exchange rate risk, normally the asset managers should make a choice. Cross-border banking is political, so since I'm not a political scientist, I will skip this question. However, single supervision versus centralized, on here I tend to differ. Now in my new job, I see the national bank supervisor, and I see that they work hand in hand with other supervisors, with the ECB, the SSM, and it's not felt as centralization. It's felt as very, very strong cooperation with colleges of supervisors, and so I really, maybe my colleagues from the ECB or CEPR can respond on this, but I really see a difference between centralization and cooperation. For instance, in a different area, which is competition authorities, you have a very strong national competition authorities, but you have a very strong common rule book. And for large cases, it goes to the federal level. So I would not oppose the two models. And finally, regulating NBFI. So at some point, they would ask to access the balance sheet. So far, yes, the access to the balance sheet of the central bank has been, it's kind of contract with the banks. You are heavily regulated. You have a maturity mismatch, but we ensure that provided you are solvent, you will get the liquidity, whatever is needed. And so I think there is a gap until the NBFI get to this point with the same profile as banks and the same regulation as banks do have. The UK has experimented interesting one-off access to the balance sheet, very short and targeted, and with the withdrawal of the liquidity just after so this was the mini budget crisis. This is something that could be thought about. So far, there is no, but I understand your point.
Thank you so much. A big hand for Agnès.